Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview. And I'm delighted today to be joined by Mr. Robert McNally, founder and president of the Rapidan Energy Group based in Washington, D.C. Thank you, Robert, for joining us so much.
Great to be with you, and thanks for having me on today.
Well, great to have you, and we will try and get through as much as we can in the next half an hour or so. No shortage of things to talk about in the energy markets. Let's start with your take on the strength of the energy market so far this year in light of post-COVID China recovery demand. Let's look at the demand picture first. The people we talk to every day have come to some sort of consensus that it has disappointed expectations so far this year. Would you agree with that? Where do you think we're going in the second half of the year with expectations for oil demand?
You know, when we look at the existing data, the latest data on oil demand, it's coming along fine. I mean, we're recovering briskly from COVID. China is hitting record implied demand levels. India didn't even lose a beat. They're quite strong. And you know, Diala, I think the biggest overlooked area of surprising demand strength is in one of the best covered parts of the oil market, ironically, the U.S. gasoline market. U.S. gasoline demand is robustly growing. And what we're seeing with the final monthly data for U.S. gasoline, that they're exceeding the preliminary estimates based on the 4-week average. So gasoline, it hasn't quite reached in the United States pre-COVID levels, but we're getting up there. And we can talk about inventories for a second. The East Coast gasoline market is quite tight. Inventories are quite low. So, you know, look, we had COVID, we're coming out, Chinese demand's coming back. Jet demand is roaring back. Yes, we've had a problem on gas, oil, and diesel. Yes, that is affected very much by the economic slowdown. And of course, the warm winter we had and so forth. So there are certainly some pockets of demand weakness that we see in the United States and other countries, particularly in diesel. But just about every other category we think is showing surprise strength. So I would say the demand picture is a bit stronger than we give it credit for. Now, final point, unfortunately, we only see demand data, especially the hard data, with a several month lag. So we're backward looking. Of course, the market looks forward, and I'm sure we're going to talk about this, sees a lot of problems on the macroeconomic front. But the existing data, as we look at it, is showing demand is in quite good shape.
Okay, and we'll talk about the macroeconomic front, but let's talk about that demand that we just mentioned. It's been pretty healthy, you're saying, by all accounts. And let's talk a bit about the OPEC strategy in forecasting that as well, you know, in terms of the action it's taken in the last 6 months, cutting twice. Now we haven't seen the second cuts come through yet. Do you think they were right? They were just right on the money, calling the volume of cuts that they've asked for? Or what are your thoughts on that in terms of what they might do next, given where prices are?
Yeah, so OPEC Plus has to be concerned about let's call it a swoon in prices before the boom, right? I believe it's certainly Rapidan's view, and I believe this is shared by OPEC Plus leadership, that the oil market is entering the foothills of a multi-year boom price cycle. We have underinvested in supply, and demand, while having been held back by COVID and macroeconomic weakness, is going to surprise to the upside when the economy returns to health. So as we look at the next few years, and I think as OPEC Plus looks at the next few years, they see an undersupplied market They see demand exceeding net supply growth, and therefore the price having to rise sharply, given the inelasticity of oil products, to enforce the iron law of economics, which says you can't consume what you can't produce or take out of inventory. So this is very different than 2014, where OPEC was looking forward and seeing just a lot of shale growth, a lot of Brazilian growth, a lot of Canadian growth, and like saw a risk to its market share. Very different. They look forward now and they see a market that's going to get too tight. But before then, we have to deal with this macroeconomic risk. And traders, and we see this now in the positioning even as we speak today, traders are very bearish. They see a deep recession. They see downward pressure on prices. And when you see this buildup, as we have seen in speculative managed money short positioning in futures markets, and we're at almost an 11-year low, or I should say high in terms of net short positions. This is the thing that causes OPEC Plus to want to get out in front of it with preemptive, proactive cuts, such as the one they surprised us with in April. And today, or as we see this week, Minister Abdulaziz bin Salman from Saudi Arabia has once again warned the speculators, because they're back. The shorts are even bigger than they were in April, right? And he's saying, be careful, I will make you ouch. We will cut again. The OPEC Plus won't want to lose control, even for a short period of time, to financial market participants in prices. And that's why they undertook the April cut. And I think if necessary, would cut again.
And I mean, at what price do you think, what's the floor where you think they would definitely come in again because of the shorting and the speculative feeling about, as you said, the macro picture? Do you think if we go below 70, that's it? That's a trigger automatically to come in?
So from my understanding, they don't have a price floor target. And if they did, they certainly wouldn't tell anybody about it. But I don't think they do. I think they look at three things. One is positioning by speculators, managed money in the futures market. And that is flashing, you need to cut again. You need to warn them again. They also look at inventories. And, we used to just look at OECD inventories, and we still do. But now with better data visibility, we have Chinese inventories, oil on the water, other places, Fujairah, and so forth. So I think they look at inventories as well. And then they look at the term structure of the futures curve. Are we in contango, backwardation? Are we moving toward one or the other? And I think it's those three factors, especially the short positioning, that will cause them to act. And that is their main radar screen. Now, they look forward and they try and project fundamentals, right? But it's very difficult. Having been a barrel counter for 32 years now, I have to say it's getting harder and harder to have a high confidence view about the fundamentals in the oil market in the next 3 to 6 months or a year, mainly because of macroeconomic risk, not because of things necessarily emanating from the oil market. And I think OPEC Plus is in the same position. Look at the OPEC Secretariat's oil balance. It's quite tight. It sees draws, deficits in the second half. So does ours. So do other IEA and others. But with the macroeconomic risk, you can't bet the farm on those tight forecasts.
And okay, well, give us your take on the macroeconomic sort of sentiment right now in the US. Obviously being a very big producer, but also a big consumer. It has links to also impacting how China is going to behave in terms of its manufacturing and production. What is the sentiment now, 6 months almost into this year? We don't have a defined recession yet. And yet the sentiment, as you said, according to short traders, is still wary.
The sentiment is pretty awful. And it's mainly because central banks, to fight inflation, have to raise rates. And we haven't seen a sustained period of central bank rate increases like the one we're seeing now in many decades, as many as 40 years. And what happens, we are learning, or I should say being reminded, those of us old enough remember, when the Federal Reserve and central banks raise rates, they tighten credit conditions, and they often discover financial problems, bad banks, and so forth. And this raises the risk of contagion, that there could be a systemic problem in the financial markets that could cause something similar to the 2008 financial crisis. And that is something OPEC Plus has not forgotten. Traders have not forgotten. I mean, that sent oil prices from the mid $140 range to the mid $30 range in 6 months. And OPEC, while it was cutting production, was way too late to prevent that. So there's this sort of a scary recent episode, the 08 crisis. And I think that the ghost of 2008 is coming back as these central banks have to raise rates and tighten credit conditions to tackle the inflation that built up as the world returned from COVID. So it is a legitimate fear. I don't mean to say the concerns and the poor sentiment are unfounded. They're very well founded. There's huge uncertainty. And again, as we see, if things go bad in the macroeconomy and the financial system, they go bad very fast, very fast. And no question, some traders are positioning for that, especially in diesel with the amount of net short interest there.
Yeah, that's certainly that's taking a bit of a hammering for sure globally, not just in Asia, but everywhere. And you mentioned how OPEC doesn't want a repeat of that, and no producer does in terms of what could happen to prices. Of course, another time OPEC felt stressed was sort of in the 2014, 2015 era when shale was rising, and of course they came into the market, OPEC, and took some action then as well. But now, would you say that they have nothing to worry about in terms of US production going forward? It's not going to get any higher, is it? Where have we reached, in your opinion, with that?
Yeah, night and day. So 2013, 2014, anybody's forecast, showed US growing 1.5 million barrels a day production, Brazil, Canada, non-OPEC supply growth close to 2 million barrels a day a year. And meanwhile, demand was a little above 1 million. So the only way to keep oil prices stable was somebody, OPEC, Saudi Arabia, was going to have to cut. And Saudi Arabia said, and OPEC said, we're not going to cut under shale year after year after year, surrender our market share in a healthy market. We won't do it. Not without Russia. Russia initially said no. And so the history from 2014 to 2016 was convincing Russia to join in collective supply management. And it took a big price bust to do that. And then we had a little flare up in March of 2020 during COVID, we all remember. So really the history of the last, 8-9 years has been sort of OPEC's need to convince Russia primarily and other countries to cooperate and share the burden of supply management. But as you said, as we look here today, I mean, we've got total US supply, maybe up 500,000 barrels a day this year, 300,000 barrels a day or so next year. Some of that is NGLs, but lower 48 crude production is measured in the low several 100,000 barrels a day, not well above 1 million barrels a day like 2014. And so OPEC leadership, Saudi Arabia, UAE, even Russia, they don't have to worry about having to cut year after year after year under fast-growing shale. They don't. Now, we do have this belief now that demand's about to slow down and peak because of electric vehicles and fuel efficiency standards in the gasoline, the ICE car fleet. Rapidan does not share that view at all. We're very bullish on demand. However, there is a little bit of a concern about future demand growth this decade, but it's very different than 2014. Again, OPEC Plus just has to cross the bridge over these troubled macroeconomic waters. And once it gets over that bridge, we're into a tight market. It'll be able to increase production. And indeed, the concern is they won't be able to cap rising prices.
Yeah, and of course, the whole underinvestment of the last 5 years across the world is a big concern. OPEC's calling out for more investment, and hence why it needs healthy prices to continue to do that. Now, you mentioned Russia, Robert, and let's talk a bit about that. OPEC spending a lot of energy getting Russia on board in the last few years. Of course, now today we have another situation with Russia where it's at war. In Europe, it's still part of the OPEC Plus group, but really kind of doing what it wants to do on its own. How how important is Russia within the OPEC Plus group today, given the circumstances? What advantage do you think it is for the other members of OPEC to keep them on side?
Russia is still critical to OPEC Plus unity and cohesion. We have seen that when Russia refuses to cooperate with OPEC or OPEC Plus, we get price wars and price collapses. The examples of that are November 2014 and March of 2020. So we have two clear examples. Now, as long as Russia is playing along with OPEC Plus, showing up to agreements, agreeing to cuts, and so forth, then I think there's a lot of empathy and tolerance for Russia, right? Because Russia is now in that sort of gray zone. There's two categories of OPEC Plus countries. There are countries that are under sanction, like Iran or Venezuela or Libya, that have either sanctions or geopolitical disruption risks. And those countries are more or less excluded from the need to uphold quotas. And then you have the rest of the countries which are supposed to adhere to the quotas. Russia, because of its invasion of Ukraine and the sanctions that produced, is in a sort of a gray area. It's not being given an exemption from quotas. It indeed has joined with 8 other non-OPEC countries in April to cut production. But it's not sort of, I think, fully expected to adhere to the precise quota level. I think there's some tolerance for Russia built in right now, as long as Russia continues to play along, go to the meetings and so forth. Russia, as you know, has now decided to make classified all of its production data. And one of the big parlor games now among barrel counters is to figure out where Russian crude production is. How close are they getting to the 9.3 million barrels a day that they should be at in May if they're going to meet their pledged targets? And it's hard to see because they're not producing the data, and we have to get it infer it from exports, and exports have actually been quite robust. So a lot of questions there, but Russia still remains very important as long as there's the risk of a downturn. Now, once we get into the boom phase later this decade, I think Russia will matter less, because then there won't be the need for collective cuts to balance the market.
Okay, and you mentioned the boom phase and the next decade, like the coming decade, let's say, or the remainder of the decade, in the context of the energy transition is slowly but surely sort of creeping more and more into the space. And of course, one position the OPEC group has taken quite clearly is that it wants to maximize its revenues while it still can, in terms of at a reasonable price. And the other position that Saudi Arabia and those leading OPEC have taken is to pursue a more independent oil policy rather than one that appeases America, or, in the traditional sense of the relationship there. Give us your take today on this sort of bravado that we're seeing out of the Gulf a bit, in terms of, we're going to do what we want to do in our own interest 100%.
Yeah, well, so I love history, and I wrote a book about the history of crude oil price volatility and swing production and so forth. So I'm very much influenced by history, even recent history. And I think it's very important to remember that history is a sequence of phases or eras where ideas become predominant, structures exist, and then they're replaced by new ideas. And there's a cognitive bias where we tend to think that today will be, or rather the future. Let me repeat that. There's a cognitive bias where one assumes the future will always be like we expect it today, or things are today. And I don't think that's how OPEC Plus looks at the market. I don't think OPEC Plus producers are worried about squeezing every last dollar of their hydrocarbons while they can. They're looking at the trends in decarbonization policy and so forth. But I think they're starting to see, as we all have, a bit of a change in that. Between the Paris Agreement in 2015 and the election of President Biden at the end of 2020, there was high optimism, I would even say euphoria, about the likelihood that the world would be quickly transitioning off of oil to reduce emissions. But since 2021, I think there's been a slowdown or a decline in that euphoria. Russia's invasions of Ukraine, massive oil price spikes, central banks fighting inflation. We're starting to see a slower, I think, movement towards decarbonization and a recognition that we will not be getting off of oil and gas anytime soon. And you see with the UAE now in charge of COP28 and OPEC plus countries asserting themselves in the climate change discussion, saying, look, yeah, okay, we're going to decarbonize, but we're not going to just abruptly get off of oil. We just saw what that looks like, trying to get off of Russian oil. And look what happens, oil price spikes, okay? And those politicians will avoid to the end. So I think OPEC Plus is realizing that the trend is moving back towards using oil and gas, although reducing emissions by a hydrogen, ammonia, carbon capture, and so forth. There are technologies, they're very expensive, and they won't come quickly, but there are technologies that will enable us to use the hydrocarbon resources we have while decarbonizing and reducing emissions. So I think OPEC Plus is sensing a shift from this euphoria in between 2015 and 2020, and this sort of reality check that we're in now. And I think they realize, they can live and profit in that world. Their biggest concern is, especially due to this euphoric era that I discussed, we're seeing this continued underinvestment in oil and gas fields. I mean, in 2020, the International Energy Agency called for no new investment in greenfield oil and gas projects because they said we needed to get to the net zero target and we couldn't use those resources if we wanted to achieve those targets. And I think that caused a lot of concern in OPEC plus countries and around the world as well, that we were going to deliberately starve the economy of the energy resources that it needs, recognizing that hydrocarbons are 80% of the global energy primary supply.
And I mean, in terms of how the demand plays into that primary supply, the pull on that, we mentioned China a bit this morning at the beginning of our conversation. In terms of China's being obviously, one of the world's largest consumers of oil and of Gulf and OPEC oil specifically as well, it's also got a pretty ambitious energy transition story and track. It's admittedly still has its coal as backup and is still consuming that as well. But what's the expectation there on how fast it's going to be transitioning, and of course a big impact on net demand for oil, and in the context of what we had in the last year or two on that focus on energy security, any concerns that sort of big sort of giant demand coming out of China will diminish sooner rather than later?
Yeah, so I think China looked at the energy transition mainly from the supply side. It saw dominance of the electric vehicle and, for that matter, renewable electricity supply chains. So the critical minerals, the battery minerals, the refining, the wafers, the chips, and then the polysilicon and the windmills, et cetera, and the solar panels. They saw that if they could dominate those supply chains, they would replace the United States and Gulf producers who dominate the hydrocarbon energy sector and sort of lead the world that way economically. And they made this decision in 2009. So well before the Paris Agreement euphoria began, China was moving first to secure those supply lanes. And yes, it wanted to encourage its own domestic industry as part of that, because feeding its own domestic industry, its car sector with electric vehicles and renewable power would also help them solve air pollution concerns and energy security concerns. So it was two-handed, but I think it was mainly a supply issue. It was a strategic move to displace the United States as a dominant power in the transportation sector, automotive sector, and then the United States, Russia, UAE, and Saudi Arabia as the dominant hydrocarbon superpowers. Now, What we've seen, though, in the last couple of years is that there's a consensus not to allow China to dominate the supply lines for clean energy. That priority of confronting China supersedes the priority of quickly transitioning and deploying clean energy. You see this in the US IRA bill. You see this even in Europe and so forth. There are concerns about security, human rights, etc. So this means the pace of the transition must slow relative to what people thought it would be 5 years ago or so. The only way to decarbonize this decade quickly was with Chinese EVs, batteries, and with Chinese minerals and Chinese solar panels, etc. If we're going to say it's more important that we confront China and not allow China to dominate those than quickly decarbonize, then again, we're into a slower transition, which I believe we are in. We're going to have a sort of a slowing down in the consensus of the pace of decarbonization. And as part of that, we're going to realize we're going to need more oil and gas sooner. And finally, with regard to China, as we see in the United States and Europe and other countries, there is a limit to how much money the public sector, the government, will be willing to spend to sort of jumpstart the electric vehicles, right? So far, they're coming out, but they're mainly being purchased by higher income folks. The key to decarbonizing transportation is getting middle and lower income folks to want to buy and be able to afford an electric vehicle. And that is running into some headwinds. The willingness and ability to subsidize it, China has removed, especially the national level subsidies for it. And it also gets into concerns about how many minerals, how many mines do we have to open to produce the lithium and the cobalt and the copper and the other metals we will need to replace gasoline cars with electric vehicles for everybody, not just the very rich. And I think those realities are starting to dawn, the limit of spending money, and also the limit of our willingness to tolerate the mining that we'll need. And those things also are causing folks to think, hey, wait a minute, maybe electric vehicles are going to come slower than we had been hoping, after the Paris Agreement.
When you mentioned, and you mentioned the IRA bill in the US, which of course is not just about investment in cleaner energy, but there's a big budget within that, billions of dollars being given as incentives for corporates to sort of get on the bandwagon on that journey. I mean, how much impact do you think that's going to have in terms of speeding up the transition within America, within the US?
Yeah, I think it's way too soon to tell, and a lot will depend on next year's presidential and congressional election. I think the key thing that folks overlook when it comes to the IRA bill is that it did not have one Republican vote, not a single one. Even though most of the money that is being spent on clean energy is being spent in districts with Republican representatives or senators. That surprised a lot of people. But I think it shows just how polarized all policy is, especially energy and climate policy in the United States. There is this broader concern amidst higher interest rates and inflation about just spending on anything. So what this means is that if a Republican wins the White House and comes into office in January of 2025, he or she could reverse all of that spending. And if the Congress is Republican and the president is Republican, they could move to start to reverse some of the IRA provisions. Some are very popular, like production tax credits for wind and solar have bipartisan support. That's not a problem. I think the earlier versions of the electric vehicle subsidies may survive, but a lot of the extra spending, particularly from the DOEs, I think the Loan Program Office, I think a lot of that could be canceled in a Republican administration, especially if we're still into an inflationary period, rising debt, and concern about spending overall. So I think it's very premature to say with high confidence whether the IRA bill is a game changer for clean energy development.
Okay, Robert, well, before we wrap up, let's get your take on that expenditure and debt and inflation we've touched on. It's certainly coming a little bit under control, it seems, but any concerns by the energy sector or any commodities markets on this debt ceiling deadline that's coming up? Are most people assuming something will be reached, some deal will be reached? But really beyond that, there are fundamental concerns about the derivatives of the impact of what we're really talking about here. Just more and more debt, more expenditure, more printing of money. Will we see that bubble come to an end, do you think?
It's a great question. I hope we can have another interview and just talk about this, because I think it's a underappreciated and crucial question. And I do have thoughts on that I hope we can share at one point. But let me say this. I'm pretty confident that we will avoid a default this time. Why? Because the leadership negotiating the debt agreement does not want to see a default. And I think they have the ability to prevail and urge their caucuses in the Congress to go along. So Speaker McCarthy, I think, does not want a default. He is strengthened because the House did pass a debt limit bill. And I think, he and President Biden will come to a deal. We may have to have a short extension to finish the talks, but I think everybody in the room, President Biden, Speaker McCarthy, certainly Leader McConnell, and the Minority Whip Jeffries and Senator Schumer, they don't want to default. So I think we're going to get past it this one time. But the question you raised, I think, is very important. I tell my clients, that there's that picture of a hockey stick graph, supposedly, of temperatures throughout the millennia, showing temperatures rising very sharply, catastrophically in the last 100 years or so. I think the real hockey stick graph, the real threat to the global economy and the energy sector in some ways is the debt. Because even if we get to healthy GDP growth and we end the wars and we don't have a war with China and Russia's invasion of Ukraine stops, even then our debt situation is still catastrophic, because the United States especially, but other countries as well, but the United States has promised hundreds of trillions of dollars in retirement benefits, what we call so-called entitlement programs. This is for elderly folks for income and for medical care. Hundreds of trillions of dollars in the coming decades that is not in the tax code. That's an implicit debt that you never hear about alongside the $32 trillion public debt. So this is a problem that is going to have an earthquake effect on U.S. politics, much more so than climate change. We are going to be seized with this in the coming years and decades as the boomer generation retires, and they continue to retire, and they demand those benefits. So you raise a great question. I tell my friends in the investing in oil and managing oil companies, your risk is not climate policy. I think Ukraine has shown officials don't really have the courage to impose heavy costs on consumers to achieve climate change objectives. However, as our debt situation deteriorates and retirement benefits are something the public cares about very deeply, that is a bigger risk, because that could be a bigger excuse to seize profits and assets from lucrative sectors like energy to pay off these enormous implicit promises that have been made to retirees. So your debt question is, I think, very important and overlooked, and will have a much bigger impact on the political discussion around energy than climate change.
Well, Robert McNally, I think we'll stop on that very interesting note to take you up on further next time we meet. Founder and president of Rapidan Energy Group. Thanks so much for joining us today. It's been a pleasure talking to you and getting your insight.
Thank you so much for having me. Have a great afternoon. Really enjoyed it.